This is a basic example on how to apply our expected credit losses. ABC Limited provided XYZ Limited with a loan of 1 million at an interest of 8% per annum. The interest and loan are repayable after 3 years. ABC Limited classifies the loan as a financial asset at amortized cost. ABC Limited estimates that the loan on initial recognition has a probability of default of 0.5% over the next 12 months. Now, what does this mean? There's a probability that XYZ Limited will not be able to repay the loan, and this probability is 0.5%. Therefore, there is the probability that they will repay the loan of 99.5%. At reporting date, ABC Limited determines that there has not been a significant increase in the credit risk of the loan since initial recognition, and the probability PD remained unchanged at 5%. ABC Limited determines that 25% of the gross carrying amount of the loan will be lost if the loan defaults. Therefore, guys, if the loan defaults, if they will not pay, 25% of the 1 million will be lost. Therefore, 1 million times 25% will be lost. There's an assumption used in this example that our gross carrying amount remains to be the 1 million. We do not have sufficient information to calculate and include our amortization table. Now, I just briefly want to go through our steps. Step 1, in terms of IAS 32, we've identified that this is a financial asset in the records of ABC Limited. In terms of IFRS 9, they've provided us with a classification, a financial asset at amortized cost. Now we have identified that there is a possible credit loss, and we need to use our expected credit loss model to calculate the loss allowance. Now, when you refer to our table, we have identified in terms of IFRS 9 that our financial assets will be divided into 3 categories. My question, do we have to use our simplified approach, our lifetime expected approach, or our general approach to determine our loss allowance? In which category will our financial asset at amortized cost fall into? Our first category relates to trade receivables, IFRS 15 and IFRS 16. Therefore, no, not within our simplified approach. Our next category is financial assets that are credit impaired. Guys, this loan, the probability of default is 0.5%. Therefore, no, this is not credit impaired. And this will fall within other financial assets within our general approach. Now, on initial recognition, how do we measure the expected credit loss allowance? They've indicated to us that the probability is 0.5%. Therefore, guys, the probability that they will pay is 99.5%, which is actually pretty good. Okay. Therefore, we will recognize a loss allowance equal to the 12-month expected credit loss using the 12-month probability default of 0.5%. To be able to calculate this, we need to first calculate what will our lifetime expected credit loss be. They've indicated to us that this will be the 25% times our 1 million, and this is our lifetime expected credit loss, and this is 250,000. Therefore, our 12-month expected credit loss will be our 250,000 times 0.5%, and this will be an amount of 1250. Now, at the end of our 3 years, they have indicated to us that there has not been a significant increase in the credit risk. Therefore, guys, when you have a look at our general approach, no significant increase in credit risk, we will recognize our 12-month expected credit loss of 1250, and this amount will not change.